Welcome everyone to at MakerDAO. In these meetings, we're going to be covering a lot, and it's going to be pretty interesting. I'm looking forward to it. We're going to be talking about everything from base principles around what scientific governance means, what the risk means, what the risk framework is. And we'll be from there potentially moving into some high-level definitions of financial and risk terms, and we'll be touching on eventually, we'll be getting into the actual mechanics of how does MakerDAO do governance and how does MakerDAO actually evaluate risk. So we have a great deal to get to in this series of meetings. Joining us, we have Jess and Stephen Becker. Jess, do you want to introduce yourself?
Hey, I'm Jess, and I'm a community and events manager, and I'm going to be helping moderate the chat. So if you have questions and you really want me to make sure that they're answered, please alert me through the chat here.
And Stephen, let us know who you are.
Hi, Stephen Becker. I'm head of risk at Maker, and hopefully we'll be able to clarify a few things today.
All right. You've recently released a document that I think that internally we've all been pretty amazed about. I think it's incredibly important, and I think it's going to be one of the seminal documents when we look back on the evolution of MakerDAO. I encourage everybody to read it. We have links in the YouTube description. We have links in the meeting agenda, so people should have a look at that doc. You go over a lot of really fascinating ideas, and I think that there's a great introduction to a lot of critical concepts in there as well. Do you want to talk a bit about that for us and give us an introduction?
Yes, yeah, by all means. So the first thing I want to talk about is, what is risk management? Because the definition of risk management is always contextual. So we need to set up the context with respect to MakerDAO. The most important part about this is that instead of trying to go through classifications of what types of risk there is in a system, it's actually a lot easier to have a look at the layers of risk that we're facing. I mean, we have an economic layer where we have a look at the governance structure of how the supply of dye is actually manufactured. We've got the financial risk layer where we actually are exposed to certain volatilities. And then we have the business risk layer or the operational risk layer. So now the aim of risk management is to be able to identify the risks throughout all these layers and then combine them together in a coherent construct that allows you to focus on only to try and manage this whole thing. I mean, the result of this will effectively be the underpinnings to create not only the stability and the integrity of the system, but the stability in the actual stablecoin itself. So that is ultimately what we're trying to do with risk management and risk constructs. And my job is to understand these various layers and to be able to identify these risks, to put metrics to them, to be able to manage them and diagnose them, and then express them in some sort of template form so people can look at and take away from it and say, well, what can I do with this myself? How can I add on to it? What are the benefits in this? And obviously, what are the gaps? And what are the solutions to those gaps? And the one thing that I think we need to then focus on, that's the high-level view. But when we come closer to Earth, we can start focusing on simple, very pragmatic aspects, such as how do we assess collateral that we want to put into the system? What does that mean? What does it mean to actually have collateral, and what are we trying to accomplish using the actual construct of a CDP and the pledging of collateral? So from a very high level down to a very narrow level, that pretty much is the full idea of risk management. So on that basis, any thoughts, comments, questions?
Well, I'm hesitant to jump in because I think that each one of those concepts that you just mentioned are kind of huge and require a deep dive. So,
okay, so I take it that the general idea is well understood. Then we can
I have a question. So the how-tos of the risk management, we assume that we want to make it easy for people to learn about risk management if they're interested in participating in the system. So I know that Rich is working on a whole bunch of like the fact stuff. Is there going to be like how-tos for all the different levels of risk and layers of risk in there? Or are you guys looking for a way to make it a digestible sort of educational resource?
Yes, this is basically the step one in this very long process. There are going to be a couple of avenues that you could follow. One would be, referring back to the series of community calls and getting your head around it. I'd probably say at the end of the third part of the risk governance article that I'm going to publish, I'll start coming out with more focused papers on specific models and their applications with respect to risk parameters that we all are a lot more au fait with. For instance, liquidation ratio, the debt ceiling, and the stability fee. So it's a broad view, and then we're going to narrow it down to the actual scientific models that we're going to, and then holistically as a system. But I kind of like to take the baby steps to try and get each one of the concepts well understood and lay the foundation for how we're going to see this going forward.
Cool, man. Thanks.
Okay. So then I think if there are no further questions with respect to that first little bit of commentary, the second one is, well, the most interesting aspect of it all is, how do we actually decentralize this function? What's the benefit of decentralizing? The notion of decentralizing has already been Prabhu in his previous meetings, and I think it is one of the the core concepts that you have, obviously, with the DAO. But in terms of a risk management function, where does that actually fit into this? The reason that you think about it is that it's a very technocratic concept. You want to sort of defer, or you want to proxy your vote to someone or a group that has an experience with respect to these notions, and they have experience with respect to how to understand them and manifest them in a way that is easily understandable for someone to make decisions. So it's a business intelligence aspect as well. And the one thing that's really interesting about decentralization is two concepts: competition and collaboration. And what I mean by that is that a risk process or risk function is a process. There's initial inputs, there's a whole bunch of steps, and then there are outputs. That is effectively it. And each of those processes, the breadth of each of these processes sort of represents the breadth of the function, but each of those steps represents a vertical. Now, what am I talking about? What we're looking for are risk teams to come and contribute towards this process. Now, they can do it in one of two ways. They can either contribute entirely to the process, outlining everything from start to end, or they can actually contribute to a specific step in this process. Now, this becomes a lot more interesting because teams that contribute to the entire process can compete with each other. And then, Maker token holders, acting as governors, can choose between them which one makes more sense. Or, they could actually choose all of them and weight them appropriately, so that would effectively have a synergistic role and contribute a lot better in terms of the parameters and the metrics that they what's really interesting is that a risk team that may want to contribute to the system could just focus on a single step. So in that way, they could actually cooperate amongst themselves. They could collaborate amongst themselves. You might find a risk team's output for a specific step will be the input for another risk team. A very good example comes to mind, and that is quality assurance on data. Now, I'm sure everybody is quite au fait with the fact that trying to get data that is representative of what actually is happening in the market is pretty difficult for two reasons. One is how it's collected, but two, and the most importantly, is the underlying idea of wash trading. And that effect that it has on not only the pricing, but the volumes and what it represents. So you might find the team has, they might be able to identify the metrics to filter out wash trading, or they may be able to create a functionality that aggregates data in a much better way. So
maybe can I jump in really quickly?
Yeah, by all means.
So yeah, sanitizing and validating data sets, that's something I hadn't considered, and that's probably going to be critical because it's garbage in, garbage out, right? So how do we do that from a high level? Do we say that we only accept information from these sources, or do we expect these teams to be pulling apart each other's data sets to ensure validity of them?
Well, the first step that you take is creating reproducible research. And what that means is that whatever you have defined or devised as a functional metric, you need to encapsulate the data that you've used. Now, why is that important? Because you're accountable to that data. That uses it will be able to say, well, this is the data that I used to get these results. Now, why am I saying this specifically? Because that data may be wrong, but the model may be right. So to be able to validate those models, everyone can use that same incorrect data, come out with the correct answers, and say this model is correct. But by the way, where did you get your data from? Then the question might be, well, I used an API and I downloaded it from XYZ organization, or I went to the publicly available CoinMarketCap. And there will be a filtering point where you'd say, okay, so you use CoinMarketCap. Do you understand how they aggregate data? Do you understand how they compile it together and what it means to use that data? Now, I'm also from the traditional world, and I can tell you something very clear, that if you have Bloomberg on one side and Reuters on the other side, and you went and download data past 20 years, I assure you that when you compare them, they would be different. It happens at the sort of the highest level of service provision. So when you come down to, and I do mean come down to the crypto level of aggregating data, there's going to be a lot less quality in this data. So more integrity checks will need to be put in place, but more importantly, we need to accept them as well.
What of data? Sorry, I'm gonna get my question first, Justin. Then what data sources do you predict people will be using in these models? Is it primarily just exchange-related information, like how well it's traded, or are we also talking about financials and business licenses and things like that?
Well, the qualitative assessment will essentially be very high-level white papers, pitch decks, and so on and so forth. As soon as we get a little bit more organized in terms of these organizations, I would imagine there'll be financial statements and there'll be some sort of representation of that organization being made more public. And you can use that for your qualitative assessments. But in terms of the second layer, the sort of financial risk that I'm talking about, we are going to have to predominantly rely on the trading data that we get from the likes of CoinMarketCap, as an example. We need to keep in mind that there's going to be quality issues, and we need to adjust for them when we actually go about our calculations. But for purposes of actually creating risk constructs, it's more important, the first step is more important to get the model correct and the model validated, and the model understood is very important, but in this context, it's secondary. Because ultimately everyone can then say, right, let's now all agree on what source of data we are going to put our faith into.
Okay, that makes sense. It seems like this might be an opportunity for an oracle or a group of oracles in the future to, I guess, agree on the validity of trading data, but it's a tough problem because exchanges lie about their own trading data. So how do we get accurate information? All right, well, I'm just throwing that out there as an unanswerable question. Jess, did you say something from the meeting?
Sure. So we have several interesting questions. One, how is it that we intend to attract risk teams, and how would the community go ahead and gauge the reputability of those risk teams?
That is something I would be happy to hear your suggestions on. because right now this is simply an understand of the format and function, and through that I'm hoping that it would invigorate folks to contribute. And then it'll probably come to the fore that a certain structure will be needed, and we need to then address that appropriately. But for now, I don't know how we're going to do that explicitly. In terms of the reputation, well, that will be twofold. One, in terms of how you construct yourself in the beginning. I mean, if you are an individual that has just wrapped a model together and is contributing a parameter, that's fine, but then there is a need to show commitment for a medium to long-term horizon on that contribution. And that has to be gauged. So if you're an individual by yourself, kind of hard to put that forward. But if you incorporate or you create a legal entity that wraps around that function, it's a little bit more in terms of what that intent is.
Well, I have kind of a follow-up question to that, because I'm curious about what the motivation would be for an outside risk team. Why would a team want to form?
I have an idea. I have an idea on how to answer your question, Rich.
Take it away, Jim.
So, assuming that there's going to be institutional interest in the MakerDAO platform, I don't think that it would be too far-fetched for institutions to seek like a grant from like the L4 fund or from maybe the foundation itself, or even fund themselves to have maybe like some sort of risk team on their own to contribute to the project. But it would have to be an institution with like either a big enough actual, like, I don't know what would be the incentive, because like besides using the system, I mean, I guess they would themselves want to ensure that it's working well. So that's the only thing that I can think of to that question.
The incentive is a little bit more holistic, and it actually boils down to the construct of a decentralized framework. In this case, every Maker token holder is both an activist investor and is a director on a board of directors, right? So the way that they ensure that their investment is looked after is twofold. One, through their voting structure, through their tokens, but two, is their participation in the entire structure. And one of those points of participation is actually creating risk teams. And it'll literally be part and parcel with your ability to invest. Now, everyone knows, and sorry, I may be assuming this, but I think it's pretty intuitive that everyone knows that every investment that you make is based on a risk-return framework. So if everyone is looking at the return framework, we need to be able to give them the ability to undertake a risk framework as well. There's their incentive. There is the incentive to get involved, almost from an activist point of view, to say, well, I think that governance should put their best foot forward with respect to what the DAO is doing, but at the same time, I think I can put my best foot forward in terms of what risks we should be taking.
Yeah, that makes sense. I'm starting to see it now. Ashley, you had a good point. Did you want to make that verbally so we get it on tape? If you're muted still.
Yeah, I was just saying that ultimately Maker token holders are the buyers of last resort, sort of. Maker tokens are minted to cover a shortfall if they allow bad collateral types onto the system. So all of our largest investors are very much planning to be involved in the risk analysis process, and whether it's from a direct point of view, sort of working with Steven's team, or whether it's on their own and sort of doing independent reviews of the risk collateral that we put out. So yeah, basically the thing to keep in mind is that this whole system is designed with incentives in mind, right? And so to Steven's point, each Maker token holder, depending on the size of their stake or what have you, really does have an incentive to ensure that these CDPs are appropriately risk adjusted.
Yeah, I love that actually. So it's building in. Sorry, it's building in another layer of checks and balances, which I hadn't considered. Which I think that's awesome.
Exactly.
So go ahead, David.
Yeah, my concern, another one of my concerns about like institutions getting into risk analysis and doing risk teams is what incentivizes them to publicize their work. Because I think that if we want multiple risk teams and people to vote on it, they would have to publicize it. But it would be in their best interest to keep it private, because if they disagree with like the main risk profile, maybe it would give them a step to like move to a competing stablecoin or not. Like, I don't know. I'm just thinking of like hypothetical examples, but I don't know what gets them
it's
to.
actually a very good. That's a very good point, and the reason that is a good point is twofold. One, you're going to have these explicit teams and these implicit teams. The explicit teams are going to contribute and be very transparent. The implicit teams may contribute, but they won't tell you where they got their calculations from. And it'll be up to Maker token holders, from a governance point of view, to decide what sort of weighting you want to put on them in terms of their contribution towards the collective. Because keep in mind that the decentralized function is supposed to, as a net benefit, come out with the highest model for the entire system. It's like an ensemble in machine learning. You combine a whole bunch of models, be them basic or complex, but when you put them together and they are weighted appropriately, and almost like a voting format, it is actually shown that the variance decreases and your overall model will actually be better. So that's where it wouldn't be in the best interest of an institution to try and keep their assessments to themselves, because by contributing, they actually add to the overall assessment, to the quality of it. So consequently, giving them even better information about their risk position, and consequently giving them a better idea about the risk return profile.
Solid answer.
Any more with respect to sort of decentralized aspect of this function? Because it's really carefully the process.
It might be early to get into this, but is there a roadmap of how to implement this kind of thing, or is it we publish the models and we see how our stakeholders pick up on it, or will there be interaction with the large funds that Ashley mentioned before or during our launch?
I think it's going to be a little bit organic and a little bit iterative. There's no explicit way of going out and saying this is the way forward. You've got to first show it, and the way that we show it, and this is what's going to happen in what's going to be shown in part 2 of the governance article, is the internal risk team. That's myself and the guys representing this team. We're going to show what risk team 0 looks like, what a template looks like, so that we can give a sense of what business intelligence you can derive. And that's going to give you a better sense of where you fit in terms of MKR as an investment, or MKR as a representation in growing the economy on the blockchain. And that is hopefully, with this kind of series and the papers that will follow and the models that we can play with, will induce folks to either create teams themselves or merely just comment on what actually is there. So either way, there's a lot of angles to this, and how it actually will manifest, I'm not terribly sure.
Yeah, Ashley, do you want to go ahead and ask your question for Stephen?
Yeah, sure. I was just wanting you to comment on, and you kind of touched on this earlier, but there likely are going to be different types of risk teams, and you can imagine, and they're particularly as the product becomes more complex, there are going to be many different sort of levers that you can pull in order to get different risk and interest rate results. And I'm wondering what happens in the situation where, let's say, for example, Maker's team is probably going to err on the side of caution and tend to be pretty risk averse, but maybe there's another risk team and large Maker stakeholders that have the feeling of higher risk, higher reward, and that's something that they're comfortable with. How are you going to come to consensus, and is there going to be a mechanism by which community members can get an understanding of, okay, I'm voting with the conservative side, or I'm voting with the risky side? How is that consensus going to be achieved?
Well, the first part of that consensus is understand sorry, let me just. The first part of the consensus is going to come with understanding what is initially contributed from a risk team. So someone will come with a risk construct, and that construct will be reproducible in terms of its results. And the community will need to vote on it in terms of how applicable it is to its overall risk function. If they find that the risk construct being offered is more or less the same than what they've got, you might find that they won't include it, or they'll include it with a low weighting. And if you find that there's a risk construct that is completely different to the ones that they have, it may be included with a similar weighting or maybe higher. Everything will sort of default to an equal weighting at first, but iteratively it'll increase or decrease as their longevity and as their applicability becomes obvious. Now, in terms of what you just asked, the bias, you're going to have natural bias. And the way that you address that natural bias is by diversifying the amount of risk teams that you have. So ultimately, we would have a construct with many risk teams offering many biases, which will then average out to being more or less representative of the community. At first, like any other construct, like a startup, you're going to find that the bias might be specific, almost plutocratic, if you will, to one set of ideals. So from the internal risk point of view, it's going to be inherently conservative. But as the notion of risk and risk assessment catches on, as more teams contribute towards the overall function, so you might find that bias sway. And it'll sway until it finds its median, and that median will represent what I believe would be the community values and ideals at the time. Doesn't mean that it won't change going forward. It is a function of what the community as governors will ultimately want.
Do you think someday we'll have parties within the maker holders?
You basically sort of like cartels looking at specific biases.
Yeah.
Probably. I can't answer, definitely, but it's the very nature of, I suppose, humans just to group together and tend towards certain biases. But that is inherently a success metric for me, because if you start finding that, then you know that you develop into a more sort of mature level of operation, and that maturity will then bring about a whole lot of complexities with respect to real governance. Like, how do you actually go about employing representative voting over each of these constructs and over the scientific notion overall? So yes, I would think that would happen.
That's a great point. I think that's something that touches on a topic that we've tackled in some of the other meetings. Is that in our space, people kind of want it's a highly technical space, and people want magic algorithms to save us. And I think realistically, magic algorithms can never be complex enough to save us, and that's why we need to have governance to evolve over time and introduce these checks and balances.
Yeah, the one aspect that. Sorry, carry on, Rich.
Well, I was going to jump into two other questions really fast, but if you wanted to add something.
No, carry on. Let's hit I prefer the questions. I like the interaction.
All right. Well, these are going to be kind of tough ones, so get ready. Will these risk teams be public? Will risk team A be like, hi, we're polychain and this is our risk assessment, or is it going to be pseudo-anonymous?
They'll be mostly up to them. The point being is, it's not so much the case of if they're public or not. It boils down to their construct being transparent, obvious, applicable, and committed. That's really what is important.
Sure, that's where I'm going.
Yeah.
Sorry, I'm a serial interrupter, and I need to start working on that. So I'm just curious about the reputational aspect, because people, if they have a reputation, they're going to want to capitalize on that. And if we're worried about, like as Ashley said, political parties and cartels forming, one of the ways that you can get around that is to remove the reputational aspect. But there's also benefits involved with that as well. So we can assume that, this major corporation, like if a KPMG or somebody comes along and says, here's our risk assessment, that might be worth taking a double look at, right?
But here's a real one for everyone to consider. I mean, what happens if Goldman Sachs creates a risk team?
Are they here to destroy us, or are they here to help us?
Well, that's the thing. You know, that's exactly what I'm putting forward, is that you're looking at this and you think the monster has come, or, oh my goodness, you know, someone from the traditional finance space maybe, you know, twigged onto, you know, something very important. It's a very difficult thing to weigh up. And, you know, that brand to it, that it either inflicts, you know, some sort of damage in your soul, thinking, oh my God, the monster has arrived, or it basically validates this idea that, okay, what we're doing is right because Goldman Sachs is here. It's a conflict. It's something we probably will have to address going forward. But right now, in terms of the branding, anonymity might be the way forward, but it's a little nascent to decide how someone should be represented, because that branding might be justifiable if it comes from a very independent source, like if it's Ernst & Young.
Yeah, there's transparency involved as well, because as you said, we'll be releasing the first proposals, and so in the interest of transparency, we probably want to make sure that everybody understood that this came from an internal source, right?
Yeah.
So if we did put our stamp on it.
If anything, the most important thing is that the internal team is completely transparent to who it is, what they're doing, and how it's happening. Because we are literally, I got a very weird job. I mentioned this before. Ultimately, my job is to make everyone else out there do my job. And that is the only way you can do that, is by constructing a very clear, very transparent, and very public idea of what it is we're trying to get at, so it's easily replicable. And
yeah.
Okay.
Sorry, and that leads me into my second major gotcha. So let's see how you deal with this one. So if we do go down this reputational road, and if we do talk about transparency and sort of trying to find a balance between those two things, my guess would be that MakerDAO Foundation proposals will probably carry some more weight than others, presumably. Are we going to sort of insulate ourselves from outside influence? So if we're working on a proposal or some model, do we have a sort of responsibility not to accept outside influence as we come up with this thing? So we've created this independent of outside influence, or is that
not
going
really.
to be a collaborative effort?
It has to be collaborative to a point of view. There's got to be the ability to accept a different point of view if it is valid and it can be proven to be valid. So, you know, I may come out with model ABC, but, you know, as an example, David points out, listen, there's some great research in this particular avenue. Why don't you employ that? And at the same time, you know, I'm going to do a risk construct as well. Well, ultimately, one needs to consider that if it actually improves the value proposition, if it actually improves the risk metric calculation.
I think that, yeah, that's great. And it probably comes back to one of the overarching themes that we need to keep in back of mind, is that this is scientific governance, like scientific being the key word, a scientific framework. So if the model is sound, the data is sound, the process is open, then you have to kind of accuse science as being biased. So as long as we have rationality, science, and transparency built into it, the accusations of bias lose weight.
Yeah, the one aspect that I probably would like to, well, actually the one point I'd like to represent here is the scientific method ultimately is best guess. You know, it is not de facto truth. It's around that, then we can always employ the scientific method in its true form to constantly be searching out for the next best thing. It's an ongoing thing. It's a continuous thing. But in doing so, you manage to filter out biases. You manage to filter out vitriol. You manage to filter out the trolls and the likes that are trying to influence by or through being a bad actor. That's what it does do very well. But what it won't ultimately do is find like the absolute truth or the absolute risk or the absolute management structure to look after the system as a whole. It is an ongoing process.
Yeah, Michael Dunworth presents an interesting point. Mike, do you want to go ahead and speak to your point yourself, or do you want me to go ahead and read it?
Hey guys, can you hear me?
Yes, indeed.
Oh, okay, cool. Sorry, hold on. Oh shit. Sorry, I just opened my computer. But no, I was just thinking, like, with regards to Goldman Sachs and all that kind of stuff, in terms of, they might want to, squash the bug and paint a whole lot of sort of FUD around like a promising opportunity or project. I think that was sort of the case where a lot of these platforms, or like a lot of these sort of incumbents, they've tried to put out research that is poking holes in things, and it comes off pretty manufactured and more that they're just less educated about the space. And I think if they're trying to gain credibility for the next 10 to 15 years of their business, obviously this is a pretty optimistic opinion, but if you're in charge over there and you want to keep in business for the next 10 to 15 years, you're probably going to want to absorb this 3.0 market to get them on your side or show that you're doing research. So I think they're going to try and, if you look at BitMEX's research that they put out, it's pretty biased. Pretty unbiased. That is a really good example of the stuff that they would be wishing that they had internally. That's my guess. But again, I play these things pretty naively and pretty optimistically that people act a lot better than they probably do. I just can't see them benefiting enough. I mean, that whole kind of conversation of blockchain, not Bitcoin, that was a 2014 thing. Private blockchains are going to be a thing. I think the market sort of squashed that idea really quickly, and it's painted the picture of, it's new entrepreneurs and it's a new infrastructure. So, adapt to it or, or slowly sort of zombie out of relevance. That's the end of my word soup. Sorry, by the way.
Yeah, thank you. That's a beautiful word soup.
Yeah, that's interesting. The one thing that's, being from the traditional space, the one thing I can say with a lot of confidence is that what your traditional behemoths say is not necessarily what they're doing. If they come out and say crypto is bad, the way forward is this, that basically means they're focused on crypto. They are doing it in the background, and they basically are establishing it to a point where they're deciding whether it's a viable business case. It's always happening in each of these big institutions. And what they then slowly do is they change their phrasing in how they see things until enough time goes by where they've actually said black in the beginning and end up saying white at the end. It's just a tactic. It's a way they do it. And it's being used successfully over if you have a look at Lloyd Blankfein, in the beginning, Goldman Sachs was, oh my goodness, this is rubbish. And now, all of a sudden, Blankfein's language is more conducive to being open to crypto. It's happening. It's a viable point. These guys are going to put their best foot forward, and they're going to do so either in a large way, or they're going to do it in a very strategic way.
Yeah, no, I agree. And I think they've got kind of, with the Jamie Dimon comments, back when he's like, Bitcoin's no good or whatever it was, sort of like 12 or 15 months ago or something. I'm pretty sure that they had already taken out positions in Bitcoin by that time. As far as like we understand sort of on our end, where we were pretty sure that had already started happening. So I definitely know there's sort of what's actually going on under the hood. That's affecting the balance sheet, and then what's sort of presenting, all good green pastures. This is nothing to worry about, as earnings reports are on the horizon and things like that, I suppose.
What's interesting about your comment is it allows me to segue into the next topic, which is, where do we place our trust with these various stablecoin types? The business case, which has become prevalent, is to have a look at IOU type tokens, the Tether, the Circle, the TrueUSD. It's got the so-called best business case for these institutions right now. They're looking at the bottom line and they're saying to themselves, well, I ultimately want to try and make some money off of this as quickly as possible. That's a good model. But where's the trust placed? It's pretty obvious. The trust is still centralized in an institution. And we've come to accept that, and we see how it works. But at the same time, it's not something where you look at and go, okay, that's wrong or right. It's just that's a type, that's an option. The obvious next one is, the lineage or the algorithmic types, and the same sort of situation. Where do you place the trust? The trust is, very much in an organization on the blockchain or in the algorithm that they deploy to the blockchain. And you got to look at that and say, well, fine, I see that as a choice, but what is the environment? What's the context in which it would actually function appropriately? And with respect to us, collateralization is, for all intents and purposes, the best way forward, because it represents the intersection of good economics, good philosophy, and practical aspects of what the blockchain represents. So the one aspect about the collateralized route, the way that MakerDAO is creating its supply of stablecoin, is that it's saying, we do have our own sets of governing dynamics. We do have our own sets of so-called algorithms that you could follow, but ultimately your faith in the collateral, which by extension means your trust is placed in the growth of the economy of the blockchain. And that is ultimately the most important thing here, because what does the blockchain in terms of the economy represent to you? Do you see it as a transferred economy? Do you think that ultimately the traditional economy will move onto the blockchain? Or do you think that it adds an extra dimension to our existing economy by augmenting a new, granular, refined economic characteristic? Or maybe it's a combination of the two. Now, the one aspect that is really important about this discernment is that a stable coin that is fully decentralized is really the way to go in terms of actually facilitating the growth of the economy on the blockchain. And that is also to say that in order to facilitate that growth, you need to have trust and faith in the blockchain and its ability to do so in the first place. So once again, these stable coin types and the hybrids that you can make out of them, it's really a case of where you're placing your trust. Now, I'm not going to go disparage any of them, because I don't think that this is the sort of thing I want to do right now. But I am in this position because I feel and I believe, and from a logical standpoint, I see that the collateralized stablecoin being fully decentralized is the way forward. And what we then need to do is...
Sorry, that's a good point, but there could potentially be a lot of reasons why you'd think that, and I'm curious about what they are. Do you think it's just some of the inherent principles of the blockchain sort of have this long tail effect where, like, transparency, trustlessness, permissionless, cross-border, no geopolitical influences? Are those the reasons why collateral on-chain backed stablecoins are the best option, or is it because of something like the wider economic ecosystem?
Economic ecosystem. The ability for the blockchain to inherently create an economy for itself that either is working with the traditional economy or is basically transferring economy onto it. That is ultimately what I'm asking is, what is your belief? What do you think that this blockchain is ultimately going to represent? And, for me, I think it's going to represent a hybrid of transferring some of the media that is not functioning appropriately and not functioning efficiently onto the blockchain. Some of it will still remain, but at the same time, there's going to be a refinement to new industries, new ideas that the blockchain is going to allow to flourish. So as a combination, you're going to have the ability to sit back and say, well, I used to have my trust in the centralized traditional finance space, but now I can actually get my trust onto the blockchain, and specifically the growth in the economy on the blockchain. But in doing so, I need to find out a way to facilitate that growth. I need to find out a way of actually representing the very atomic structures of building that economy. And the basis of that is transactions. And transactions require stable value. And I think the rest can be actually deduced from that. Therefore, you need a decentralized stablecoin.
I just add sorry, if I could just add a comment. This is Mike. I think as well, like the reason why you have, this totally centralized stuff, which is, you call it your PayPals, your Venmos, whatever you want to call it. And then you've got the decentralized ones, which actually, I suppose, custodian balances on, whether that's on like a platform like Wire, Coinbase, Kraken, where we have a US dollar balance for you. That's the promise that we've got money in the bank for you. The next version is, well, we're going to mint that, but you're going to be able to make it interoperable. So like the Tether, the True USD, or the Circle USD types. And then there's the sort of all blazing kind of totally decentralized, collateralized with what are deemed valuable assets. So when if I collateralize it with ETH, I know that ETH is worth something, and I believe in the ecosystem. So there's like a very clear understanding, and it talks to that market really, really well. I think when you look at sort of the incumbents or the people that say, well, Circle is Goldman Sachs and we feel comfortable with that, it is like a hybrid approach, because you need a hybrid approach for adoption, and education barriers mean hybrid approaches, they soften that education barrier. So when you say DAI is this incredible like machine that is all on chain, people immediately just guards up. It's too much information to take in. I'm terrified by this because I don't know. Now, just sort of like if you think about in the analogy that we use internally when we talk about stuff like this is like if you look at the internet, what it is today and what it was at the beginning, everyone had these random sort of, names on internet forums, and you wouldn't post pictures of yourself or anything like that. And that's because it gradually took time for me to, be anonymous with some random username in a chat room. And then eventually I have a personal website and then a personal blog. Then social media comes out and I've got my own social media page. Now it's like, if you said to someone at the start of the internet, like let's say 1994, hey, come out and I want you to tag everywhere you're eating lunch, everything you're doing today. I want you to upload selfies of yourself and I want you to share that with everyone in the world. All creeps, weirdos, cool people, not cool people, family members, whatever. People would be like, get the hell out of here. And I think that's part of it's a grooming process, and it took 14 or 15 years with the internet. But I think it'll be a much faster paced thing when it comes to understanding the value of the blockchain. That was just sort of in comment to the hybrid approach.
Yeah, there's a transitional aspect to stable coins that in a decade from now we're going to look back and it's going to be pretty obvious that, oh yes, of course, I see how you would have the likes of TrueUSD and Circle, and then eventually that would dovetail into working nicely with a decentralized coin, and then obviously whatever the next manifestation may be, it'll become that historical aspect where it defines the transition very clearly. We're probably only really know sometime in the future, but it actually talks to what you're saying. How you adopt things, how you get educated by it, is by looking at the first case, the easy case. That's why Circle has been deployed, because it is seen as the easiest method, and it makes effectively from a dollars and cents point of view the most viable business method going forward. But in terms of its longevity on the blockchain, it's always going to have to dovetail with something. And it's not a bad thing, it's just going to be interesting. Okay, so let me see, where are we? Rich, how are we doing with time and moving along?
We got farther than I expected. We have 7 more minutes. We could jump into the next major topic. I don't think we have time, though. If there's any random questions people wanted to ask, now would be a good time. Or Stephen, if you had some overarching points that you wanted to make in the meeting before we had to shut down, that'd be good too.
Oh, okay. Well, let me just open it to any further questions, and if not, then I'll just finish up with the last little topic. So, any other questions, comments? So far, the comments have been fantastic. Thank you very much for that, and the questions as well. Absolutely supreme. Okay, I assume nothing. Cool.
So Mike makes
any questions?
brilliant comment. Mike, do you want to say your comment?
Sorry, guys. Yeah, no, just basically, the more on-ramps you have, it's sort of like a short-term threat, long-term advantage. In the same capacity of, people have talked about digitized national currencies. Like, oh, we're gonna put the US dollar on the blockchain. The faster that happens, the faster that education learning curve, gets closed out. So essentially, in a short term, like if this was a stock, right? I mean, well, theoretically it is in a way, but if you think of this, like if we've got a Q1, Q2, Q3 earnings report, yes, it's going to get bashed to pieces if all these stable coins start coming out that are hybrids. But the long-term effect is that you guys are building an absorbing asset that is purely decentralized and collateralized, and all those teams are increasing the education learning curve sort of velocity. And basically, you want people to get as close to the blockchain as possible. If they're not going to get into DAI, then let's have them as close as possible to a blockchain-based stablecoin, because then they'll be like, wow, this is really interesting. And then they'll start, they start at 60% understanding instead of sort of 0 to DAI. A similar example might be with sort of centralized exchanges and decentralized exchanges. If decentralized exchanges are more advantageous because there's no counterparty risk, if you have lots of people on centralized exchanges and I'm, let's say, Radar Relay or Oasis Dex, I'm going to be like, oh, why isn't everyone trading with us? But if you now have 10 million people, 20, 30, 40, and that scales really aggressively, when someone gets hacked or something happens to those people, the impact is not a dollar value impact, it's the surface area that's impacted. So if Mt. Gox, right, if they had 500,000 users when they got hacked, even though it was worth $500 million, if they had 500,000 users when they got hacked, if Coinbase got hacked for the exact same amount right now, Coinbase has about 28,000 customer wallets. That is, 28 million customer wallets. That is 28 million really pissed off voices that are going to be trying to complain and whinge. And that is going to speed up their understanding to be, how am I never going to have this happen to me again? There is a thing called decentralized exchanges. And that forces them to look for alternatives and chat more and more. So essentially, yeah, basically, it's not as threatening long-term. It's can be a sort of seem, again, maybe I'm too trusting and too optimistic, but I think there's a path where it's a very exciting thing to have other people bridge that education gap for you guys, in a sense.
Yes, valid points. I actually see that. I actually do see that. Any other questions, comments? Michael, that was stellar. Thanks for that.
Yeah, those were all great comments and questions today. I had a feeling that this would spark some really interesting conversations, and it did. I'm looking forward to next week. I think we might want to wrap it up at this point, though.
Okay.
Thanks, Ashley. Thanks, Michael. Thanks, David, for all of the great questions. Thank you, Stephen, most of all. And we'll be having this meeting again next Thursday, 9 a.m. PST. So I'm hoping to see everybody back.
Super. Thanks, folks. Much appreciated. Enjoy the rest of your day or evening.
All right. Bye-bye, everybody.
Ciao.